There are many schools of thought out there that each tell you how you should manage your finances with a goal to stay debt-free. And they all have some merit to them, but they also have some flaws with them that one might want to consider. I prefer to take from each methodology the stuff that works and discard the pieces that do not work in order to assemble a plan that can take me from where I am to where I want to be. Am I just babbling on? Well, yeah, but with a point. There are people out there that tell you that you should not have any credit. Some would call that debt, or as little credit as possible. And that is simply not true if you have certain goals in life. I'll explain what I mean further in this video. After introductions, of course. I'm Derek West, host of Finance Squared, the channel that loves to talk about all things personal finance, including credit, debt, stocks, crypto, and so much more. If that's your thing, be sure to subscribe and turn on post notifications so you don't miss a pulse-pounding second of the action. But that does beg the question of who might you be? Drop a comment down below, letting the community know what your misconceptions about credit are, and what you're hoping to learn from this video. There are many misconceptions out there that keep people from truly living their dreams, and even worse, keeping people from even dreaming big at all. Now that's unfortunate, but that's why I'm here, to help clear up some misconceptions. Things like credit and debt. For example, a common misconception is that credit and debt are bad things. Saying credit is bad is like saying fire is bad. Fire can be bad if it gives you third-degree burns, but it can be good if it helps to roast your vegan barbecue. So it's about using the tool appropriately and in the right context. Nevertheless, the trope that credit is bad is something that I believed for a long time, and it's something that actually held me back from going further, faster in my journey to financial independence. My main hangup was not wanting to have any more debt after the experiences I had getting student loans and getting into debt that way. Those student loans motivated me to pay them off as soon as possible, taking just about any job, even if that job was not the right one for me. So that experience biased me against credit in general, and it kind of blinded me to the possibilities that are out there when you use credit wisely and you use your finances wisely. I'll have to admit it, there were some so-called financial gurus that I trusted who helped to confirm my biases with certain misconceptions, such as, for example, a good credit score rewards you for being in debt to banks and credit card companies. While that is sort of true, it is kind of the pessimistic view of that relationship. And if you look a little bit deeper, it's not exactly 100% true, and it's sort of misleading and can cause plenty of folks to go down the wrong road. One of the possibilities overlooked by a lot of people is having a perfect credit score or near perfect score, and how that can impact your financial future. Every point that you can lower your interest rates on major purchases such as cars or houses, well, that's much more money that you can save and invest. And if you're really doing it right, when you're borrowing money to purchase an investment, you're really kicking your financial life into the next gear. And getting good credit is about showing creditors that you are a worthwhile risk, that you can pay on time. And when you can't, you can communicate to them by asking for an extension. In that same vein, and sort of inspired by the same line of thinking that having fewer credit cards is possibly a good thing, is the misconception that less credit is a good thing. Now don't get me wrong, you don't want to have more credit cards than you know what to do with, or can reasonably expect to pay off or even use. That isn't good for your credit score either, but you want to have enough to where you can keep your monthly aggregate credit utilization under 30% and as close to zero as possible. Let's go over a concrete example here. If you have 5 credit cards with a $5,000 credit on each of them, that makes your aggregate credit at $25,000. If you spend on your credit cards about $5,000, then your aggregate credit utilization is 20%, which means your credit utilization is under the threshold for when you get seriously dinged on your credit score. Let me be clear, that's just an example, and I would suggest you keep your average credit spending much less than that. Ideally, you want to have a balance of $0 carried month to month on your credit cards. And the easiest way to do that is just to spend what you would spend on simple bills like groceries, maybe your gym membership, things like that. Occasionally, you'd put big purchases such as appliances or electronics on a credit card and pay those off slowly. But there will be little to no hit on your credit if you have more aggregate credit, not less. So if you only have $5,000 in aggregate credit and you have a balance of $5,000 that, yes, you're paying off, you're still going to take a hit because you're using 100% of your total credit, which is considered risky in the eyes of credit reporting bureaus. Another point that I think is misconstrued quite often is that you want less total credit. It's a similar misconception as having fewer credit cards. The thing is, you want more credit available to you, not less. You can achieve that by having more credit cards or having higher credit on each card. Again, it's simple grade school math. If you have 2 credit cards, each with a $5,000 limit, you have $10,000 aggregate credit. But if you have 1 credit card with a $10,000 limit, admittedly hard to pull off, you'll have the same effect. That is, if you keep your balance under the 20 to 30% utilization threshold, you will not be dinged on your credit score. And more importantly, just like above, when you do get in a situation where you need to put a large purchase on a credit card, because you have a higher credit limit, you have a larger buffer. So you have more peace of mind that you are not going into a place where your credit card balance will affect your credit score. Now, I said earlier that I take the pieces of financial philosophies at work and utilize them to take me from where I am to where I want to be. Well, that means that there are some good things coming out of financial gurus that can help you and me get to where we want to be. For instance, there are things that you do want less of when it comes to credit and credit cards. Less debt per credit card, for example. I talked about credit utilization just a bit earlier, and it's worth repeating. You don't want to use 100% of your available credit. That signals to credit reporting companies that you're in desperate straits or that you're being risky with the credit that you've been given. You don't want to be even close. The preferred amount that you can be in that will not ding your credit score is between 20 and 30% credit utilization. So if you have a $5,000 credit limit, then you should only approach between $1,000 to $1,500 on your credit balance. Any more than that, and you'll start to appear risky to reporting bureaus and to lenders. Let's talk about your balances month to month. You're going to want to keep your month-to-month balances near zero. In other words, try not to carry a balance month-to-month at all. If you utilize a credit card, pay it off within 30 days of incurring the charge. Admittedly, that's hard to do with larger purchases unless you have a plan. There are times when large purchases sneak up on us unexpectedly, and that's where having an emergency fund of savings is key. So you don't have to put that sneaky large payment on a credit card, which can turn your finances upside down if you get in a tough spot. Also, if you know you're going to be making a large purchase in the coming months, put aside money specifically to make that purchase. Put it on your credit card, assuming you're not approaching the 20 to 30% threshold of total credit utilization, that is, and then pay it off using the money that you just put aside. Again, this ensures that you're reviewed as a solid investment by financial institutions, who then reward you with a nice credit score and lots of low interest loans to take your financial future to the next level. You also want to keep your credit inquiries to a minimum. If you have no credit cards, this happens by default, as your credit score is never checked. But if you're constantly looking for new credit cards to sign up for and are therefore applying to tons of credit card companies, that is a lot of inquiries into credit history. And the simple inquiries alone can cause a minor, yet not insignificant hit to your overall credit score. Do research on the credit cards that make the most sense for you. Apply only to the ones that fit that criteria, and take a breather between new inquiries as well. The number of new applications for credit over 12 months can make up to 10% of your FICO credit score. And the more credit cards that are approved and opened, the worse your credit score will be. That's because the age of your credit account contributes to your overall credit score as well. Newer accounts ding you. Older, good standing credit accounts make your credit score rise. Also, credit card issuers have begun to get wise to the process of credit card churning. You know, where you open up credit cards strictly to get the sign-up bonuses and then simply never use the card again. And they begin to adjust accordingly by denying applicants if they attempt to apply for too many credit cards in too short of a time. Now, getting denied a new credit card actually doesn't affect your credit score at all, so that isn't a huge deal. It's just a waste of time to try it. So with that, folks, be sure to like the video if you like this video. Subscribe to this channel if you want more videos just like it. Leave a thought down below on why you need more credit, not less, and other things in credit cards that you should have less of. We're all dying to know. And remember, a goal without a plan is a wish. A goal with a plan and no action is a wish list. Take it easy, guys. I'll catch you in the next video. Peace.